Hello, welcome to the weekly technical analysis review for Monday, December the 2nd. I'm Rafi Barajan at xm.com, and for this week we're going to be looking at the dollar versus the Swiss franc, the Kiwi dollar and the euro pound. So let's start with the dollar versus the Swiss franc. Looking at the near-term picture, we can see that although the bullish bias is still intact, the MACD is in positive territory. Stochastics are pointing downwards, and we do have prices slipping today, pointing to some downside momentum. And then if that was to continue, support should arrive at the 50% Fibonacci retracement of the downleg from 1.0235 to 0.9659. So that falls at 0.9947. It's also where the 200-day moving average is currently converging, and below that we've got further support levels. We've got the 20-day moving average as well as the 50-day moving average at 0.9930, and then if those levels fail as well, the focus would turn to the 38.2% Fibonacci at 0.9879, and then lower down we've got that key support level of 0.9840, which acted as support several times this year, and so if that level was to fail as well, we would see the pair starting to look bearish once again. At the moment, the medium-term picture is looking neutral to bullish, but the pair does need to break above the 61.8% Fibonacci at 1.0015 in order to give us a more convincing sign that is definitely looking bullish in the longer term outlook, because otherwise there would be the risk of the pair starting to stay stuck in a neutral structure. And then further up, the next focus, the next level to come into focus would be the 78.6% Fibonacci at 1.0112. Let's now turn to the New Zealand dollar versus the Japanese yen. We can see the pair is on the verge of turning bullish in the medium term. Prices had struggled to break above the top of the Ichimoku cloud, and now they've cleared that and they're heading towards the 200-day moving average, currently at 71.25. Looking at the momentum indicators though, they suggest there's a risk of a downside correction because they are looking somewhat overbought at the moment, but if we do see the current upwards run extending and breaking above the 200-day moving average, the next level to come into sight is the 50% Fibonacci at 71.53. So that's the Fibonacci retracement of the downleg from 76.77 to 66.30. But in order to, before we can confidently say that Kiwi yen is definitely now looking very much bullish in the medium term, prices would need to break above the 61.8% Fibonacci at 72.77. If though we do get a downside correction, immediate support should come at 70.30, that's the 38.2% Fibonacci, and below that we've got another strong support area there. We can see there's the Tenkan Sen and Kijun Sen lines of the Ichimoku cloud, followed by the 20-day moving average at 69.69. So prices, if prices were to slip below those key levels, we could see the pair tumbling towards the 50-day moving average and near the 23.6% Fibonacci at 68.77. That would take prices back inside the Ichimoku cloud, and we would see the short-term bias turning bearish again, and that would also bring into focus the key 68 handle. And finally for today, let's have a look at euro pound. It's fairly neutral in the short term. The MACD, although it's negative territory, it's sitting just above its red signal line. Looking at the stochastics though, they are in oversold territory, so the pair could be due an upside correction. If that was to happen, initial resistance should come at the 200% Fibonacci extension of the uplift from 0.8785 to 0.90 0.8519. So that is at 0.8553 and near the mid Bollinger Band, also the 20-day moving average. Clearing that hurdle could see prices climbing towards the 161.8% Fibonacci at 0.8642, and then further up is the 50-day moving average at 0.8670. So a climb above the 50-day moving average would help erase the bearish structure, and the pair would start looking much more neutral. But in order to see some positive signs, you would need to see the pair climbing further towards the 200-day moving average near 0.8785. Otherwise, the pair would be stuck in a neutral to bearish picture in the medium term. To the downside, we do have immediate support at the low Bollinger Band, which is near that 7-month low of 0.8499 touched last week. If prices were to slip below the low Bollinger Band, we've got 0.8480 support level. So that was an important support level earlier in 2019. Further down, we've got the 261.8% Fibonacci extension at 0.8409, and then below that, the next key level for the bears would be the 0.83 handle, which was another previous support level. So that's it from me. Thank you much for watching, and have a great day.